Last year, banks and lenders collected over $12 billion from Americans in overdraft fees, late fees, and payday loan interest. Not from rich people, from people who were already struggling. That's not an accident. That's a business model. Every fee you've ever paid for being a few dollars short wasn't a mistake in the system. It was the system, working exactly as designed. You've been told being broke is about bad decisions, about not trying hard enough. But what if the truth is uglier than that? What if an entire industry is built on purpose to profit every single time you struggle? In the next 10 minutes, I'm going to show you exactly how this machine works, who's cashing in, and how you step outside of it for good. Stay with me. Section 1. The Overdraft Machine. Let's start with the one almost everyone has felt, the overdraft fee. Picture this. You've got $40 in your account. You grab coffee, gas, maybe a few groceries. Nothing crazy. But your bank doesn't decline the transaction. It approves it anyway. Then it charges you $35 for the privilege of going negative. That's not customer service. That's a trap built into the software. Banks made billions of dollars from overdraft fees last year. Internal studies have shown something wild for over a decade. A tiny percentage of customers, the ones living closest to the edge, generate the overwhelming majority of that revenue. Some banks even used to reorder your transactions, processing the biggest purchase first instead of in the order you made them. Why? Because it drains your balance faster. That triggers more overdrafts on the smaller purchases that follow. One withdrawal becomes 4 fees instead of 1. Here's the part that should make you angry. The people paying these fees are disproportionately the ones who can least afford them. Someone with a comfortable cushion never even notices this system exists. It's invisible to them. But if you've ever lived paycheck to paycheck, you've felt it. You already know. And it's not just banks doing this by accident. It's a revenue line, a department, a forecasted number. Somewhere in a spreadsheet, a projection exists for exactly how much money will come from people falling short this quarter. You are not the customer in this equation. You're the product. Your shortage is the business. Once you see that, you can't unsee it. And once you see it, you can start defending yourself against it. Section 2. The payday loan and buy now, pay later trap. Now let's talk about the industry that takes this even further. Payday loans and their shiny new cousin, buy now, pay later. Payday loans are marketed as quick help, a bridge to your next paycheck. But the average payday loan carries an interest rate equivalent to almost 400% annually, not 4%. 400. Borrow $300, and it's entirely normal to end up repaying it multiple times over. Most people can't pay it off in one cycle, so they roll it over and over and over again. This isn't a flaw in the payday loan model. It is the model. The entire business is built on the assumption that most borrowers won't pay it back in one shot. The rollover fees are where the real profit lives, not the original loan. Buy now, pay later apps look nothing like payday loans on the surface. Sleek app, cute checkout button, split into 4 easy payments. But underneath, it's the same psychology repackaged for a generation raised on checkout buttons. It makes overspending feel weightless in the moment. Then the fees for missed payments hit later, when you're least prepared for them. Here's the uncomfortable truth. These products aren't targeted at everyone equally. They are marketed hardest at people already under financial stress. Stress narrows your thinking down to right now and blinds you to next month. That's not a coincidence. That's the entire marketing strategy. Once you understand that the ad, the app, the offer is designed to catch you at your most desperate moment, you stop seeing it as a helpful tool. You start seeing it as a predator, waiting for weakness. 3. The poverty tax hiding in plain sight. There's a third layer to this system, and it's the quietest one. Fee-based checking accounts and subprime credit cards. Roughly 1 in 20 American households don't use a traditional bank account at all. Not because they don't want one, but because minimum balance requirements and fees push them out. So where do they go instead? Check cashing stores that take a cut of every paycheck. Prepaid cards loaded with fees for withdrawing your own money. Subprime credit cards with annual fees just to access a $300 credit limit at interest rates north of 30%. Here's the cruel irony. The less money you have, the more expensive it becomes to simply exist inside the financial system. Wealthy people get fee-free accounts, cashback rewards, and low interest rates because banks compete for their business. People with less get punished with fees for the crime of having less. The financial system doesn't charge you more because you're risky. It charges you more because you have fewer alternatives and less negotiating power. This is why the phrase, "it's expensive to be poor," isn't just a saying. It's a measurable, mathematical reality, built brick by brick, fee by fee, into how modern banking operates. And look, none of this is your fault. You didn't design overdraft software. You didn't set payday loan interest rates. You didn't build the subprime credit tier. But once you know the machine exists, you can stop blaming yourself for getting caught in it. You can start building your way out of it on purpose. Section 4. The exit plan. So here's how you actually step outside this system, starting today. First, kill the overdraft trap completely. Most banks let you opt out of overdraft coverage for debit transactions. That means instead of getting hit with a $35 fee, your card just gets declined. Embarrassing for 5 seconds. Free forever after that. Second, build what I call a $100 buffer. Not a full emergency fund, just a small cushion sitting in your checking account that you never touch. That single buffer eliminates the majority of overdraft situations before they ever happen. It's small enough to build fast, and it's the first brick removed from the machine. Third, if you're already inside a payday loan or buy now, pay later cycle, prioritize paying off the loan with the highest rollover cost first, not the smallest balance. The rollover fees are where the real damage compounds. That's where you cut first. Fourth, look into credit unions and community banks. Because they're member-owned instead of shareholder-owned, their entire incentive structure is different. Lower fees, lower overdraft charges, often free checking with no minimum balance at all. You're not just changing banks, you're changing which team is profiting off your money. None of this happens overnight, and I'm not going to pretend it does. But every one of these steps removes you from a system that was counting on you staying stuck. Every fee you avoid is a fee that machine doesn't collect. Every dollar you keep is a dollar working for you instead of a shareholder you'll never meet. Here's what I want you to take from this. Being broke was never a personality flaw. It was never proof that you don't try hard enough or that you're bad with money. There is an entire multi-billion-dollar industry engineered on purpose to profit from people in exactly your position. Once you see the machine, you stop feeling ashamed of getting caught in it. You start getting strategic about escaping it. Opt out of overdraft. Build your buffer. Attack the highest cost debt first. Move your money somewhere it's respected, not exploited. Small moves. Real ones. You were never the problem. The system was built to make you think you were. Now you know better. So go do better. I'll see you in the next one.